Hallelujah. All right, so hopefully this is now up and running. If you're having any problems, what I'm going to try to do is have the chat feature going, and you can hopefully do that via chat, and then I'll answer those questions as we go along. I do think that it's kind of lagging a little bit, but that's okay. So I know the questions will be lagging where I am in the lecture, but so be it. So what I'm going to do is kind of try to make this work. All right, so we're going to be talking about chapter 22. We're going to be going through all this different stuff that's in the lecture guide. I'm going to try to move quickly through a lot of things, and then if at the end of the day you have some questions or something like that, again, just use the chat feature, and I'm going to do my best to pay attention to what's going on in the chat feature. Thank you, Lily. It's a little bit lagged, but we're getting there. All right, so here we go. Let's go some background first. And so when we talk about changes in error analysis, the first thing we're talking about is changes. And so when we have accounting changes, there are really three major types. The first one is that you could have a change in accounting principle. One example of that would be if a company is using LIFO and they decide to change to FIFO or back and forth. And so it's two acceptable accounting methods or principles, and they just change between one or the other. Other examples might be, for instance, when they had option accounting. There was a time where you could choose between the intrinsic value method and also the fair value method, and so you could switch between those two, and those would be changes in accounting principle. And there's others as well. Another type of change is a change in accounting estimate. So if you're depreciating an asset, something like extending the useful life or changing from double declining balance to straight line or something like that, those are changes in accounting estimates. So those aren't those are different than changes in accounting principles. Another change is a change in reporting entity. And so when we talk about change in reporting entity, that would be kind of like a reorganization. So you might be organized in geographic segments, and then change, instead of geographic segments, you might instead be using business segments. You could also potentially go from 4 segments to 5 segments, or reorganize your company. And so those are other types of accounting changes. The other type of thing we're going to talk about in this chapter is accounting for errors. And so errors are intentional or unintentional misstatements of financial information, or it could be the misapplication of accounting rules. And so these are kind of bigger deals typically because somebody's done something wrong. Again, it could be intentional, it might be unintentional, but something has definitely gone wrong. And so those are usually a little more substantial to correct. All right, let's focus on changes in accounting principle first. There are several possible approaches when we talk about changes in accounting principle. One is called changing things or reporting changes currently. And so you basically have this cumulative effect. So let's say I change the way that I do my inventory accounting. Well, if I make that change, it's going to change cost of goods sold for however many years back, if you kind of think about it. And so there's a cumulative effect on income year over year over year. If you use this approach, basically you don't restate anything in a prior year, you don't change anything, you just kind of accumulate the effect on this year's income statement. And so if your income over the last 5 years would have been $20,000 more, you just have that as a an additional item on your income statement in the current year. And so again, that's just one approach. A second approach is retrospectively, which basically means you sort of recast all your financial statements, acting as if the new principle were always in place. And so you're going to have restated financial statements, you're going to have adjustments to the earliest retained earnings presented, and this is a bigger change for sure, but it also gives you a lot more information, and so it allows you to really make year-over-year comparisons rather than having sort of one method in the prior year and a new method in the current year. So that's a lot different. And the last one is prospectively. Basically, you don't make any changes to balances. You don't have an adjustment to your income statement, nothing like that. You just basically say, okay, now we have this new system, and whatever happens from here happens from here. So you can see there's just 3 different ways that we can handle it. And so under US GAAP and under IFRS right now, we do make these changes retrospectively, which I do think provides the best and most complete information. And so anyway, so as we do this, we're going to be thinking about this retrospective change as we do an example. All right, there are 2 primary steps whenever we walk through an example. First of all, you do need to adjust financial statements for any years that have been presented. The second thing, as far as this retrospective approach, is you do have to adjust carrying amounts of assets and liabilities all the way back to the first year presented. And so retained earnings is also going to be adjusted, and so you're going to have a lot of adjusted balances as part of this. The other thing you do have to do is disclose the nature of the change and the reason why you made the change. And then also you do have to describe the method. So any prior period information that's been changed, any effect on income, anything like that, you need to disclose all of that information. So again, retrospective changes are pretty substantial. All right, so let's do an example. 49er Company started operations on January 1st, 2019, and they used the LIFO method for inventory accounting all the way through December 31st, 2021. And this was the income as it was reported from 2019 to 2021. Net income in 2019 was $10,000, in 2020 was $12,500, and then in 2021 is $11,000. For those students who are kind of following the lecture, I formatted this a little bit differently than what you see in the problem in your notes, and it's just a little easier to, I think, digest in this format, so that's why I'm using it. All right, so they also have a good question about those steps. Do we need to know how to do the journal entry? I'm not going to be going back a few slides. I'm not going to go in there and say list out the steps. I think that's more just knowing what you need to do and knowing what you're responsible for presenting. So within the context of a test, I'm not going to, it's not going to be that kind of detail. So good question. As far as the inventory balances, there are these 3 inventory balances in 2019, 2020, and 2021, 4,000, 3,500, and back to 4,000. And so, again, this is all using LIFO. Then they decide we're going to change to FIFO. And so on January 1st, 2022, they make this transition to FIFO. There could be any number of reasons they might make the change. They'd have to disclose those reasons. But they're just making this change. And so what I've done here is in one sort of table, I can show you how the income would have changed had they reported under FIFO in those prior years, 2019, 2020, and 2021. And so you can see that income would have been higher in each year because of that change. And so let's talk about the journal entry. And so the first thing we're going to do is kind of think about that cumulative income. And so I'm going to bounce back a little bit. And you can see that in 2019, 2020, 2021, the accumulated income would have been $33,500. Similarly, under FIFO, if you accumulate income over the same 3 years, it would have been $37,300. So there is a cumulative difference in income between the two systems, and that cumulative difference is $3,800. So under FIFO, the cumulative income would have been more than it had been reported under LIFO. And so this becomes really important to understand when we make the journal entry, because if there's a cumulative effect, you absolutely need to be able to follow the accumulation of income, and we're going to see where that accumulation shows up in the journal entry next. Maybe. We're getting there. All right, here we go. All right, so what accounts are going to be part of this journal entry? First of all, retained earnings. Because there's been a change in our cumulative income, there will be an effect on our retained earnings account balance. And then the other piece of that is going to be inventory. And this has to come from your intuition. So anytime we have one of these problems, there's really not an easy way to memorize what you need to do. You really kind of need to think about what accounts are going to be affected by this change. And we can hopefully see Sorry, just another question in the stream that I want to answer since it came up. What if they gave cost of goods sold instead of income? Essentially, those are synonymous for this particular example. So because the inventory effect, I could have just as easily said there's a change in cost of goods sold as I could have said there's a change to income. And so those two things are kind of synonymous. And so in this case, I just went with income. I think in the previous or the other lecture, I did cost of goods sold just to illustrate both. But regardless, whether it's when we talk about this change in inventory, there's the cumulative effect on retained earnings, and then you have to imagine what is the other. And I want to be very careful here. Because we made the change on January 1st, 2022, the key is you have to be thinking about permanent accounts. Permanent accounts, because we know that there is this effect on cost of goods sold. We know that's true, and ultimately there's an effect on income. But after every year, that cost of goods sold account is closed out, and it's closed to retain earnings. But there's this other part, which is the way that we handle our inventory account balance. And so there are really two permanent accounts that are affected by this change: retained earnings and inventory. If we had made this change, let's say partially through the year, then there could be some temporary accounts as well. I'm not going to have that for tests or anything like that, but I just want you to be aware that depending on when you make the change, there could be temporary accounts affected as well. But since we implemented the change at the beginning of a year, we don't have to worry about it. It's just going to be permanent accounts. And so those two permanent accounts are retained earnings and inventory. And so it's really key that you think about permanent accounts. The most common mistake that I see from students whenever they're doing the journal entry, they want to think about temporary accounts. They want to think about cost of goods sold for this kind of example, but understand that account has been closed. And so you got to be thinking about the permanent accounts. All right, so with this journal entry, of course, there's an increase to our cumulative income, which means we need to increase our retained earnings. And of course, there's also then the increase to inventory in the same amount, $3,800. Now, the financial statements is probably where the challenge is a little bigger for most students, just most. And the reason why is because getting to that journal entry, of course, understanding the concept of what's going on is important. But now you've got to kind of get to the nuts and bolts of it and say, okay, now we've got to think about on December 31st, 2022, I'm going to have 3 years income statements and 2 years balance sheets to present. And I have to present any prior years as if I had always been using FIFO. And since I've always been using LIFO, there's going to be a restated amount for some, but not all accounts. And so what I've done here is I've given you the 2020 and 2021 income statements. And so we have these 2 years, and this is what was originally reported when we had used LIFO. Now we've got to think about what will be restated amounts for each of these accounts. And so what I'm going to kind of throw in here is that reference, sort of looking back at that prior information, looking at the change in income year over year. And so we can see that there's a $2,000 difference in 2019, there's a $500 difference in 2020, and there's a $1,300 difference in 2021. Notice at the end of 2022, though, you only have to present 2020 and 2021, along with, of course, 2022. And then as far as the test is concerned, I had a student ask, well, how is this going to look on a test? Essentially, what you'll be given is that as reported column, and then you'll be required to fill out the restated column. And so you'll be given the as reported amounts, and then you'll need to provide the restated amounts. And so anything that you see blank here would also be blank or something similar on the test. I will admit, as I've written the test, one thing that I changed, just so you're aware, not changed is probably not the right word, one thing I've simplified is rather than having lots of different accounts, I'm going to be using kind of broad categories. So I might have like revenues, total revenues. I might have total expenses, and sort of rather than having to distinguish which accounts, I'm going to make it a little bit easier in terms of just understanding what you need to put into it. But I will be creating some practice problems on Canvas that will get right at the way the test will be formatted. So there's a little more detail that I'm requiring or that I'm providing in the lecture than what I'm going to require on the test. So anyway, so anything you see blank, that's what we're after here. And so as we move forward, first of all, we know that when you're changing the way you count for inventory, that's not going to change the sales revenue that you record. And so those are kind of easy points, just filling in the restated amounts being the same as what was originally reported. However, cost of goods sold is going to change. In the first year that's presented is 2020, and there's a $500 difference in net income. And so what you have to imagine is, well, what is the effect on cost of goods sold? If income goes up, it must be the case that cost of goods sold went down for that same amount. Again, in this particular example, we're ignoring tax effects, so that makes it a little bit easier. And so our cost of goods sold, rather than being $53,000, would be restated as $52,500 in 2020, and then that same $1,300 difference in 2021. And so rather than me sort of give you the answer right away, I want you in your own mind to think about, okay, what would that restated amount be? And so if it was originally reported $59,000, and you can see the difference in income is $1,300, what would be reported as the restated amount? And so it's sort of in your own computer there, or by yourself, just sort of the count of three. I'm going to kind of give you, if you want to put it in the chat, see if you got it right, that's fine. Or you can just say it out loud at home or whatever. But on the count of three, give me your number. 1, 2, 3. And the answer is 57,700. Hopefully you were able to get that. Again, the cost of goods sold number would decrease by $1,300. All other expenses are the same. This is only one account, so we don't have to worry about other expenses. And of course, that means that our net income in 2020 stated as $12,300 in 2021. Okay. All right, so I'm going to give it a second to catch up. Some of you are getting it right. That's good. I think I can change the latency in future streams, so I'll be doing that in the future. All right, let's make sure my audio is still working. Okay, everything's still working. So basically we use, the question is, we use net income to derive cost of goods sold. Yes, in this problem, absolutely. That's what we have to do. Okay, now I'm going to move on. If there's more questions come up, I can always go back, not a big deal. All right, so now with the balance sheet. So we had the income statement where you present 2022, 2021, and 2020. With a balance sheet, you only report 2 years. And so you, of course, would have the 2022, and that year is wrong. I missed that on the slide. Sorry about that. So it should be the 2022 financial statements on that sheet. Sorry. But all of that to say, so we'd have to report 2022 and also 2021. And we can see a list of different accounts here: inventory, other assets, total assets, liabilities, retained earnings, other equity, on and on. And so those are the as reported amounts, and again, we would need to provide those. Absolutely would need to provide those on the test, and so then we're required then to go with the restated amounts. And so again, there's a cumulative difference. Now this is probably where students will make a mistake. Let me go back to the previous slide just for a second. Notice that in 2020 the effect was only from the 2020 difference, and in 2021 the effect was only from the 2021 difference. And the reason why is because income statements are year to year. In other words, each year kind of stands alone. But as soon as you get to the balance sheet, they accumulate. And so any effect that you see on the balance sheet is going to be accumulated up to that point. And so in 2021, there were 3 years of differences that are going to all accumulate on this one change or restated amount on the balance sheet. And so originally we had reported $4,000. The cumulative difference is $3,800. So the restated amount would be $7,800. The other nice thing about this is that's also the journal entry amount. So if you remember, we had an increase to our inventory of $3,800, and so we need to increase our restated amount, $3,800, relative to the as reported amount. And so that's the whole idea here, is that you have this accumulation on the balance sheet, but year-to-year effects when it comes to the income statement. All other assets are the exact same, and total assets are $109,800. I'm just going to move what I'm looking at here real quick. Sorry. So again, the total assets are increased 3,800. Liabilities are the same, 50,000. Retained earnings also increases $3,800. Again, that's part of that journal entry. Other equity is the same, and so of course the liabilities and equity also increase $3,800. And so you can see that there are several blanks here that you'd have to fill out. But some of them are kind of freebies. And so on the test, there will be some that there aren't going to be a change, but it's going to be broader than what I have here, just so you know. All right, so now other accounting changes, just kind of walk through some of the more, I'd say, just conceptual aspects of these next two. So changes in accounting estimates, those changes are applied prospectively, meaning that I don't go back and restate anything. I don't report any cumulative effects on income or anything like that. I just basically apply the new estimate going forward. I don't amend anything. We have changes in reporting entity. You have to disclose the nature of the change and any impacts on reported income. Somebody asked if they're allowed to abbreviate on test. I'm trying to remember. So if there's any free response, as long as it's I would say as long as it's an obvious one, like RE being retained earnings, that's a great point. I would say, like, I can't think of any accounts that we might have to touch on where it's not obvious what we mean, so I think abbreviations probably would be okay. All right. As far as change in reporting entity, those are usually pretty substantial changes, and so you do need to report the impacts on that. And so there's a lot of disclosure when it comes to changes in reporting entity. You do need to report the current year's consolidated financial statements using the current state of the company. And so, again, that can be a quite substantial change. The problems on the test won't be changes in accounting estimates, and it will not be a change in reporting entity. So again, somebody asked specifically if you did, LIAB, L-I-A-B period for liability, if that would be okay. Absolutely, 100% okay. But as far as the consolidation, it's a big deal, but we're not going to cover that in this class. There's a whole class on consolidations in the MAC program where I'm sure you'll get to see a lot of things involving that. Now, accounting for errors is something we're going to spend more time on in this class, and there will be a problem on the test. So there's going to be a change in accounting principle and a change in accounting error. A combination of those two. There's going to be two different problems, and so there's just going to be, those are the two types of problems you're responsible for. So errors can be minor or significant. If there is an error, you have to restate all affected periods, all of them, even if they're not presented. So as an example, let's say that you had, as a company, discovered in 2020 that you were recognizing revenue incorrectly. And let's say you've been doing that incorrectly for 15 years. You'd actually have to go back and restate every single year. So that can be quite substantial and can be very costly, and a lot of times can very negatively impact your stock price, both in the short term and long term. So I just want you to be aware of that. That can be a big deal. All right, similar to a change in accounting principle, there may be a journal entry. This little piece is a little out of order from your lecture guide, but I just felt it flowed a little better here. The reason why I say may is because there are two types of errors. One is called a counterbalancing error. And a counterbalancing error is one that corrects itself within one period. So in other words, if I have an incorrect inventory count in 2020, as long as I do my inventory count correctly in 2021, it's going to counterbalance. Now, cost of goods sold is going to be wrong in both years. It's going to be overstated in one year and understated in the other year. But in total, it's correct. And so understand, with a counterbalancing error, if it's already counterbalanced, there's no need for a journal entry. So again, that's why we use the word may. There are also non-counterbalancing errors. And so a non-counterbalancing error is one that does not correct itself. So in other words, let's just say that for whatever reason, I always miss inventory that's in transit. Well, that doesn't correct itself. It's an ongoing problem that didn't correct itself. And so that would be a slightly different type. There's all kinds of examples of the different ones, but I just want to be aware, again, a counterbalancing error is one that will correct itself in the future. A non-counterbalancing one is one that will not. All right, let's do an example. Sorry, my throat's getting a little dry. I'm not used to talking this much. All right, so 49er company incorrectly calculated the fair value of its passive equity securities in 2017. Securities had original cost of $12,500, and the firm reported a fair value of $15,000, but should have reported a fair value of $17,000. So the income statement provided here was the income as it was reported in 2020. And so they had sales revenue, they had an unrealized holding gain from this passive investment of $2,500, other expenses, and in this case we are not going to ignore income tax effects, and so this does get a bit more complicated. And so we do have an income tax expense of $9,400 for net income of $14,100. So that's the information as it was originally reported. Here's the balance sheet as it was originally reported. The net equity investment was reported at $15,000. There were deferred tax assets and deferred tax liabilities. We're going to talk about which one this is going to affect. Maybe in the back of your mind right now. So if we have let's just kind of walk through that maybe real quick. If we have an unrealized holding gain, is that going to result in a deferred tax asset or a deferred tax liability? Again, we have to think about, okay, under U.S. GAAP, what is the book value of the asset compared to the Internal Revenue Code? Under the Internal Revenue Code, it's going to be held at cost. Under U.S. GAAP, it's going to be reported at the fair value. And so on the count of three, just again in the chat or on your own, it's DTA or DTL. It's going to result in one of the two. And so on the count of three, just kind of say it out loud. 1, 2, 3. And the answer is a DTL. Again, because the asset is more under GAAP, so we're in that greater than situation. So under U.S. GAAP, the asset is more than it is under the Internal Revenue Code. And so in that case, this will be a DTL. I provide DTA and DTL because on the test, similar to what we're doing here, you're going to have to figure out which one it is in some cases. All right. And then all the other accounts are kind of listed there. All right, so let's talk about the journal entry. Nice. All right. Good job. Most people got DTL. All right. Let's talk about the journal entry. Notice the smaller font. Anytime you see small font on one of these slides, that means there's a lot of work that's going to be going on here. All right. So let's kind of walk through this a little bit. So we do have a fair value adjustment account. So we have to think about what's going on with that fair value adjustment account, and that fair value adjustment account is gonna have. Sorry, I'm just laughing at the chat. The timing's a little off, so I'm not laughing randomly. And so there's going to be a full effect on the fair value adjustment account. So the full effect of this mistake, this error, is going to be captured in the fair value adjustment account. And so the restated fair value adjusted account balance should be $4,500 because the fair value of the asset is $17,000. The original cost was $12,500, and so the restated account balance should be $4,500. The as-reported account balance was $2,500. And so what that means is we need to increase the balance in our fair value adjustment account by $2,000, which means we need to debit that account. So that's part of our journal entry. The full effect being captured in this asset, the fair value adjustment account. The second piece is the effect on the deferred tax liability. It's very important that you remember when we talk about the deferred tax liability, it's the tax effect of the error. It's the tax effect, not the full effect, the tax effect. Now, we're going to do a little bit of math, not too much, but the restated DTL account balance should be 40% of the fair value adjustment account. And so the total difference between the $17,000 that's reported under U.S. GAAP and the $12,500 that's reported under the Internal Revenue Code is the balance in the fair value adjustment account of $4,500. So the tax effect of that difference is 40%, given a 40% tax rate, is 40% of $4,500 or $1,800. All right, so that is the tax effect from the restated balance. The as reported balance, of course, is 40% of the original difference of $2,500 or $1,000. And so you can see that we ought to have reported a DTL of $1,800. We actually reported a DTL of $1,000. And so what we have then is an entry amount of $800 to the DTL, which would be an $800 credit, which is an increase to our DTL. All right, so we have two accounts, the fair value adjustment account and the deferred tax liability account. The fair value adjustment account is the full effect. The deferred tax liability is the tax effect. There's one other account that we have to think about. And so I want you to try to think about what you think that account would be. So again, count of three. I want you to come up with that account name. 1, 2, 3. And the answer is retained earnings. Now, retained earnings, that is where the net income accumulates. So there's really two things going on with income if you think about it. There's the unrealized holding gain, but there's also a change in the income tax expense, and they offset each other. So you have the gain for the full $2,000. You have the income tax expense as $800. Now, the reason why it's not the unrealized holding gain account is because that account got closed to retained earnings. So remember, when we do these journal entries, it's all about permanent accounts, unless this happens somewhat, partly in the year or something like that. But they discovered this error, and that account has been closed. And so that's why in this case it's the retained earnings account. And the retained earnings account is going to capture the after-tax effect. And so again, the asset in this case has the full effect. The deferred tax liability has the tax effect, and the retained earnings account captures the after-tax effect. Again, this is just remembering that those temporary accounts got closed. All right, so the restated retained earnings is 60% of the $4,500. And so 60% of that gain, so in other words, there would have been this gain of $4,500. That gain would have had a after-tax amount of $2,700, 60% of $4,500. If you want to kind of think about it this way, you have the restated fair value account balance of $4,500 minus the restated DTL account balance of $1,800, and what are we left with? The after-tax effect of $2,700. Similarly, the as-reported amount is $1,500, which is 60% of the $2,500 fair value adjustment account balance, which again was the $2,500 unrealized holding gain. And again, the $2,500 minus the $1,000 in the deferred tax liability gives us the after-tax effect in retained earnings. And if you kind of think about it, then what we have here is a debit of $2,000 to our fair value adjustment account, a credit of $800 to our deferred tax liability. So this is one hopefully you can get. But again, on the count of three, I want you to give me the entry amount for the retained earnings account. 1, 2, 3. And hopefully you got a $1,200 credit, because we know if there's a total of $2,000 in debits, we need a total of $2,000 in credits, which means that's what the retained earnings account entry has to be. I'm going to stop there before we do the actual journal entry in case there are any questions, because this is kind of a heavy sheet right here. I get that. I'll just give it a minute here to catch up. Good. Just another minute. Okay, let's move on. Somebody just said it's early. It's 11 o'clock. My goodness. I've been up since 7. All right, I'm also old. I'm supposed to wake up early. I don't eat my lunch at 5, or I don't eat dinner at 4 o'clock though, so I'm not quite there yet. All right, so again, the journal entry just filling in the information that we have, the $2,000 debit to our fair value adjustment account, and the $800 credit to the DTL, and the $1,200 credit to the retained earnings. Notice that the date is the date that we find the error and correct it. And so I will say sometimes errors can be quite difficult to understand their full effect, and so sometimes companies might take months to figure out how an error has affected their financial statements and the entry that they need to do. So this can be a long, drawn-out process at times. All right, so now to the financial statements. So we're going to start with the restatement of the income statement. Again, we're talking about 2021, what's going to be reported. And you should also be aware that sometimes the company will file what's called a Form 8K. And on Form 8K, they'll disclose the fact that they had a restatement. And at the same time, sometimes they'll represent all of their financial statements with the restated amounts. So while this for sure would be presented with the 10K or the annual statements or annual report at the end of 2021, there may be an 8K filed with this information at any point. I mean, it could be in April or May or June or whatever. So just be aware that sometimes there's multiple disclosures of these restatements. It must be disclosed in the 10K, but oftentimes will also be disclosed in the 8K. And so let's talk ourselves through what's going to be reported as restated amounts. So sales revenue didn't change. Hopefully that's obvious. Now the unrealized holding gain, instead of being $2,500, should be $4,500. The other expenses didn't change, but because income before our taxes changed, our income tax expense is also going to change. Notice that the difference in the income tax expense is that $800 increase to the deferred tax liability. That's necessarily always going to be the case. So that, again, the deferred tax liability change captured the tax effect, and so that tax effect is going to show up in our income tax expense. And so our net income then, notice that's an increase of $1,200, and the reason why it's $1,200 is because we increased the gain by $2,000, but we also increased the income tax expense by $800, which means there's a net increase of $1,200. Notice that that $1,200 difference is also the after-tax effect that was reported as part of retained earnings. So just be aware of that. So again, looking at the balance sheet, this would be as originally reported. Can you help me conceptualize how the unrealized holding gain is affected? All right, so when we have the unrealized holding gain, remember that account did not get changed because it's been closed. So the account did not get changed. However, when I'm presenting my financial statements, my income statement needs to be restated. And so originally I reported a $2,500 gain, but I actually needed to report a $4,500 gain. It looks like you're already getting it answered, but I just want to be clear that the account balance and the unrealized holding gain or loss account has not changed. We just need to recast or restate our financial statement. So this is all about making sure that our financial statement users see an up-to-date and accurate income statement from 2020. That's what that is entirely about. All right, now turning our attention to the balance sheet. Again, this is everything that would have been as reported at the end of 2020, knowing that now some things have changed. First of all, the equity investment, instead of being reported at $1,500, it's going to be reported at $1,700. Now notice what I did here is I combined the equity investment account with the fair value adjustment account. And the reason why I combine it is because most often that's how it's presented. Most often you combine the two accounts, and so what we have is the net investment, instead of being $15,000, should have been reported at $17,000, and that's what we did here, is we reported the net investment at $17,000. There's no change to the deferred tax asset, there's no change to the other assets, but of course there is a change to our total assets because of the change to the equity investment account. Now turning our attention to liabilities and equity, hopefully you see that there is no change to other liabilities, but there is a change to that deferred tax liability. Again, going back to the journal entry, we increased that account by $800, which means that the new balance in the deferred tax liability is $4,300. The other thing I want to clarify is the deferred tax liability account balance captures things other than just this equity investment account. And so that's why it doesn't 100% match up. That $800 increase is included with a lot of other deferred tax liabilities, and so that's why we're reporting it this way. And then for the last two, hopefully you remember that there is a change to the retained earnings account, but there would not be a change to any other equity accounts. And so the $35,200 and the $43,500, of course, the $35,200 is the increase of $1,200 compared to the original balance of $34,000. All right, I think that is our last slide. All right, so just to sort of close this out, we finished a little ahead of time, which is great. The next time we're going to have one of these sessions, we're just going to go straight to YouTube. I'm not even going to mess with WebEx anymore. In fact, I'll make sure I highlight that on Canvas. I just think this tool is much better, especially because after a little bit, this will all be available as a recording on YouTube. And so somebody else, you can come and review what we said and all those kinds of things. And honestly, the WebEx recording features just aren't that great, so hopefully this is helpful. What we're going to do on Tuesday of next week is we'll probably go through a few examples of how to handle these. And they'll just be brand new examples. They won't even be from the practice problems or anything like that. I'll try to come up with some new ones, and that way it'll help prepare you for the test as well. So anyways, I'm going to give it a few more minutes to make sure there are no more questions. But if you want to sign off, you don't have to sit here and wait, but we'll see. All right, everybody. Have a good one.